We've got some of your charts that we actually want to run through here, but you state that stocks are massively overbought right now. First, help us break that down.
Well, there's different technical indicators you can use to gauge it. I prefer to use the RSI, which is the RSI index developed by Wells Wilder. Anytime you get over 70, Brad, you're getting a little bit overheated, but markets can stay overbought longer than short sellers can stay solvent, as well as money managers and performance gamers can chase performance. However, when you start to get to the 80 level, it starts to get to a level of what I call FOMO, a level of insanity, where you need to kind of cool things off. You often hear the term overheated economy. This is not an overheated economy. This is just simply an overheated market that started about 4 weeks ago, just based upon Fed narrative, where the market ran with it, that the Fed was going to cut rates, which they never effectively said they were going to do. They just said, we're going to pivot, we're going to pause, we're going to hold. But the markets themselves are often driven by psychology and hedging and things that sometimes we don't understand. Nevertheless, it does call, even if we don't tag the all-time high, for investors to start to tactically, what I call sector allocate, and cut back on their overweighted, overheated sectors, which include technology, consumer staples, and cyclicals, which are industrials.
So then, Jeff, if you're advising maybe investors to cut back on some of those sectors that we are seeing signs of some overbought levels, then what should people be allocating to rather than just blanket putting money to those that have underperformed this year? What are some of the key themes or key strategies that investors should be employing when they're trying to figure out how to best position?
You have to understand at some point the market's a pricing mechanism, Shauna, which simply means you can expect some type of corrective mode after the new year, sometime early in the spring. And there's a lot of unloved sectors where the fundamentals are still very strong, and yet the market has kind of shunned them. One of them is healthcare. So you might start looking at things that have actually been beaten down, things like Abbott Labs, things like Baxter International. And then on the other hand, I think that oil's got a bad rap. If we're not going into a recession, which is what the market is signaling, and I ask you or anybody out there, why has the oil market priced in a recession? And at the same time, OPEC is going to be getting together in January. They've already signaled that they're going to be cutting production, and yet it's been left in the dust. So I'm starting to rotate to healthcare. I'm starting to rotate to oil, and I'm starting to cut back on my positioning in both consumer discretionary and in technology. The two names I like best in oil are APA Corporation and Schlumberger. They're in a consolidation mode right now. They're just kind of waiting at things out, but the valuations are compelling. And if we do get a bump up in price in oil, it's already priced to a recession. So if we don't get a recession, it could be a surprise upside. So that's where I'm kind of laying my bets right now. But I certainly wouldn't completely eliminate my positions altogether in tech and in consumer discretionary, just lower my weighting.
Yeah, it's interesting as well, the move that we got out of OPEC this morning, the news of Angola actually exiting OPEC, and that country actually amounts to about 1.1 million barrels per day. So we'll see what the continuing producer group impact there is on the actual prices as well. Want to also take a look at another chart that you've been flagging here, and that's on credit card balances, because when we think about the health of the consumer, especially amid this heavy spending and holiday shopping season, you've been looking at credit card balances. For what reason, and how much of perhaps the fear of balances getting out of control based on where we're looking at this chart actually sitting at right now, how much of that permeates into next year, and when do we eventually see demand destruction?
Well, let's not associate interest rates on the market side with interest rates on credit cards. In other words, if interest rates come down on the Fed funds rate, that's not going to impact your credit card at all. Credit cards are set to a certain rate. And the fact of the matter is the consumer is spending like crazy now, and for a good reason. The market has provided a form of a wealth effect. With the market up 18 to 22% this year, people are feeling good, they're spending. And with that spending, eventually comes a buildup in credit card balances. But at the same time, one of your guests earlier mentioned that we are at one of the lowest savings rates level. And even though it's revised upward, it's still at a 30-year low. So at a 30-year low on savings rate and at an all-time high in credit cards, at some point it has to give from either side. And so if interest rates are coming down in the bond market, again, doesn't impact the credit card at all. They're still going to have to pay off. And so people are feeling good about the market. But if there's an anti-wealth effect on the market, where let's say it corrects 20% in the first quarter, that could have a rebound effect on consumers who just altogether stop spending. And it's already starting with FedEx because their shipping volumes are dropping. And it's already started with Walmart because Walmart has already said that their sales are softening, and that stock can't even catch a bid anymore. It was one of the most loved stocks, and now Walmart's been kicked to the curb. So the signs are out there. It's just that we're in the last week of the year, and there's that window dressing going on. But I think once we get past this week, I think cooler heads will prevail and people will start to realize, listen, I've got to cut back on a lot of designer brands, a lot of things in the leisure where it's just gotten way overexposed to the upside and the valuations are no longer compelling at all.
All right, Jeff Bierman, always great to get your insight there. And thanks so much for joining us here as we look ahead to maybe some of the plays that you think make the most sense for 2024. We look forward to having you back. TheoTrade's Chief Market Technician. Thanks so much.
Thank you, Shauna. Thank you, Brad. Take care.